Welcome back to the deep dive. We've got a ton of material you sent over on the aerospace and defense sector, specifically focusing today on two heavyweights, Lockheed Martin and Northrop Grumman.
That's right. We're going to compare their latest Q3 2025 results, look at their strategies going forward.
Okay, let's unpack this. Our goal here is pretty straightforward. Boil down the key financial differences, look at their competitive strengths, and importantly, the risks each one is facing right now.
Basically, give you a clear snapshot of how they stack up against each other in the current market.
And the timing is, well, perfect, isn't it? Both just dropped their earnings.
Yeah, exactly. And it's happening in what everyone seems to be calling this unprecedented demand cycle. Lots of geopolitical tension driving spending.
Which means both LMT and NOC had to update their full-year forecasts. And those updates, well, that's where things get interesting.
Definitely. But before we dive in, we absolutely have to put up the usual flag.
Right. The mandatory disclaimer. We're just guides here looking at the source materials provided. This is absolutely not financial advice. Seriously.
You really need to do your own homework, your own research, before making any investment decisions based on, well, anything you hear.
Couldn't agree more. Yeah. Okay, let's start with just the basics. The scale. LMT, Lockheed Martin, is the bigger fish here, right?
Yep. Market cap around, what, $114 billion-ish?
Compared to Northrop Grumman, NOC, which is still huge, but smaller at roughly $86 billion.
That difference in scale sort of sets the stage. Now, their businesses, how they're structured, slightly different flavors.
LMT, you think F-35 first, that's in aeronautics?
Yeah.
But they also have missiles and fire control.
That's the PASI-3 missile defense, really critical stuff.
And rotary and mission systems, think Blackhawks, Aegis combat systems on ships. And of course, space, satellites, missile warnings.
NOC, though, feels like they're really leaning into what's next. Aeronautics Systems has the B-21 Raider bomber. That's the big one.
The next-gen stealth bomber.
Exactly. Then there's defense systems doing really well with things like IBCS, that integrating command system, plus mission systems and space systems, similar areas, but maybe with a different focus.
Both of them, though, the analysts say they have this wide economic moat, which makes sense in defense.
Oh, absolutely. It's built on things you can't easily replicate, like specialized tech, but also, crucially, switching costs.
Right. If a country buys into the F-35 ecosystem.
Or relies on NOC's upcoming Sentinel ICBM replacement.
Good luck switching to something else easily or cheaply. It's almost impossible.
For LMT, that moat is reinforced by just sheer volume and incumbency. They're deep in the deterrence business, as they put it.
And that backlog number is just staggering, $179 billion.
Yeah, it's massive. That's like over 2.5 years of sales already booked. Talk about visibility. That screams stability.
NOC's advantage feels a bit different, more about strategic positioning for the future fight.
I think so. Building the next big things. Their backlog's also impressive, $91.4 billion. And their book-to-bill in Q3 was 1.17.
Meaning orders are coming in faster than they're fulfilling them. Good sign.
Definitely shows demand is strong for their offerings, too. Okay, let's pivot to the Q3 numbers themselves.
LMT reported strong top-line growth. Sales up 9% year-over-year, $18.6 billion.
Right. And their EPS, earnings per share, came in at $6.95. Solid quarter.
NOC, interestingly, had slower sales growth, up only 4% year-over-year to $10.4 billion. But
their EPS jumped 10% year-over-year to $7.67. So less sales growth, but better profitability growth in the quarter.
okay, here's where it gets really interesting. The guidance for the full year, 2025. This is where you see the strategic paths maybe diverging a bit.
Totally. LMT sounded pretty confident. They updated guidance, but they also tightened the range, raised the midpoint for sales.
Implying about 5% organic growth for the year.
And they bumped up their EPS guidance, too, to the $22.15 to $22.35 range. Seems like steady growth ahead.
Okay, contrast that with NOC.
Well, NOC also raised their EPS guidance, and significantly, actually, up to $26.05. So they're expecting strong profit. But they trimmed their full-year sales guidance slightly downward, pulled it back a bit.
So they're saying, we might not sell quite as much stuff this year as we thought, maybe due to timing on programs like in aeronautics.
But the stuff we are selling, or the contracts we have, are proving more profitable or efficient than expected. That seems to be the story. It points to maybe some execution challenges on the big new programs, but good performance on others.
Yeah, that's a key tension. Speaking of segments, NOC's defense systems had, massive growth.
19% organic growth, yeah. And mission systems had strong margins, double digits. Space was down a bit, but that was expected due to some programs winding down.
And L&T mentioned something about Q4 margins. lower expectations for space and missiles.
Yeah, they flagged that, said it was due to risk retirements on certain contracts and costs related to scaling up production, like munitions. They insisted it wasn't a structural problem, more like timing issues.
Okay, so performance is solid, but with nuances. Let's talk financial health. Balance sheet valuation.
Looking at the trailing 12 months price to earnings ratio, the PE, NOC actually looks cheaper right now, about 21.3 versus LMT closer to 27.
Interesting. And cash flow. LMT is a cash machine, isn't it?
Oh, yeah. Q3 free cash flow is huge, $3.3 billion. They're aiming for $6.6 billion for the whole year. That gives them a free cash flow margin, TTM, of about 6.26%. Pretty healthy.
How about NOC?
Lower in Q3, $1.3 billion. And their TTM margin is lower too, around 4.5%. But, and this is important, they stuck to their full year guidance, which implies really strong growth.
Like 22% annual growth at the midpoint.
Exactly. So while LMT generates more raw cash now, NOC is showing faster improvement in cash generation efficiency. They're catching up.
Okay, dividends. Big topic for investors in this space. LMT has a higher yield currently.
Yeah, 2.70%. And they just boosted the quarterly payout by 5%, plus added $2 billion to their share buyback program. Returning cash to shareholders is clearly a priority.
The payout ratio, 111%?
Yeah, 111.36%. It's remarkably high.
How is that even sustainable? Are they basically paying dividends out of debt or future hope? What's the justification?
Well, the justification goes back to that massive $179 billion backlog. Management is essentially saying, look, the cash flow is incredibly predictable and locked in for years, thanks to programs like the F-35. We know the money is coming.
So they're betting the farm on that future stability. It feels risky, though. What if there's a hiccup with the F-35?
That's the core risk for an income-focused investor in LMT. It relies heavily on continued smooth execution, NOC, by contrast.
Lower yield, 1.46%.
But a much, much safer payout ratio, only about 31%. Their dividend is very well covered by earnings. It suggests maybe more financial caution.
Okay, let's switch gears to risks and the future. Big program risks seem key for both.
Definitely. For LMT, it's always about executing on the F-35 flawlessly. Any delays or cost overruns, there are huge news. Plus ongoing supply chain issues.
Like those solid rocket motors and seekers.
Exactly. Though they are working on that with a General Dynamics joint venture. And looming out there is a $1 billion cash pension contribution needed in 2026. That's a chunk of change.
And NOC's risks seem tied directly to those big future bets they're making.
Absolutely. The B-21 Raider, initial production costs have been higher than they first expected. That puts pressure on margins early on.
And the Sentinel ICBM program is being restructured.
Yeah, they're working with the Air Force to sort of re-baseline that program. That's critical for long-term stability. And, you know, any government shutdown drama always hits contractors' cash flow. Maybe NOC is a bit exposed there, too.
So challenges tied to ambition.
Yeah.
But that ambition is also where the growth comes from, right? Innovation.
Precisely. LMT keeps investing through Skunk Works, you know, 6th-gen fighter research, upgrading the F-35 with Block 4, developing collaborative combat aircraft like Vectis. They're enhancing their current dominance.
NOC feels like they're building the foundation, pouring money into CapEx.
Over 4% of sales into capital expenditures. That's substantial. They're building capacity for things like solid rocket motors, investing $2 billion in digital transformation, setting up domestic microelectronics foundries.
Which helps reduce reliance on overseas supply chains, especially for rare earths. Smart long-term move.
And their Beacon initiative for autonomous systems points to where they see the future battlefield heading. It's a different kind of investment.
So LMT is optimizing the present. NOC is maybe spending more upfront to build the future infrastructure.
That's a good way to put it, I think. LMT focuses on high margin improvements now. NOC accepts some near-term cost pain to, they hope, own the key platforms and technologies of the 2030s.
So what does this all mean if someone's looking at the A&D sector trying to compare these two?
Okay, purely based on the facts we've walked through, and again, not investment advice.
Not advice.
It paints a fairly clear picture depending on what you prioritize. If you're looking for stability, maybe income. LMT offers that huge backlog anchor, the F-35 dominance, and that higher current dividend.
But you have to be comfortable with the higher valuation, that PE ratio, and especially that very high dividend payout ratio. That's the trade-off.
Exactly. Now, if you're perhaps more focused on growth or making a strategic bet on next-generation defense,
then NOC looks more aligned.
Potentially. The PE is lower, making it look cheaper on that metric. The dividend is much safer, better covered. And you get direct exposure to those transformative programs like the B-21, Sentinel, and the underlying tech infrastructure they're building.
The trade-off there is accepting the near-term risks, the program execution hurdles, the potentially volatile revenue forecasts as they ramp up these massive complex projects.
Right. You're betting that the upfront costs and potential delays will pay off down the line.
And underlying all this, the overall demand environment is strong for both, isn't it?
Yeah, the consensus forecast analysts have put out show pretty robust revenue and EPS growth for both companies stretching out to FY 2028. That strong demand cycle provides a solid foundation.
Which brings us to a final thought to leave people with.
I guess the big question hovering over this comparison is, will LMT's incredible efficiency with its current programs, especially the F-35 cash flow, be enough to maintain its lead while NOC spends heavily now to build potentially dominant platforms for the 2030s?
Will NOC's big bets on the B-21, on domestic microchips, fundamentally reshape the competitive landscape later this decade, justifying the costs and risks they're taking on today?
That's the multi-billion-dollar question, isn't it?
It certainly is. A great place to wrap up this comparison. Thanks for digging into the data with me.
My pleasure. Lots to think about.
And thank you out there for engaging with the deep dive. If you found this breakdown useful, please do consider subscribing to the channel. Maybe hit that bell icon. It really helps support what we do here.
We appreciate you tuning in.
We'll see you on the next deep dive.